Hi, good afternoon, and welcome to our presentation for this conference. Today we're gonna talk about the variation in stocks performance between sectors in the presence of news. Today I have with me Dr. Michael Bernardo, myself, Dr. Elliott, and Dr. James. Okay, we're gonna look at the abstract and the also the introduction. Our study is a correlation study used to examine how the impact of news on stock price differ between sectors. Our population is the New York Stock Exchange listed stock, and our population proportion, and we use 5 of the 11 sectors. We also use high and low volatility period based on the CBEO and VRX. And we also use a two-tailed multiple regression analysis to do our study. The result of our study show that news impacts stock performance in financial and consumer staples. Uh, there was no significant impact in healthcare information technology or utility during our analysis. The level of reaction to news demonstrates some dependence on assigned sectors. Now, the introduction. In our introduction, our research literature indicate there is generally some impact of stock performance from news releases regarding investor sentiments and other financial data. What is not well defined is how stock react differently to positive or negative news under specific circumstances within the market sectors and the tone of news. Uh, we also look at the market news, that is the lifetime of today's stock market. News affect the enormity of volatility, but does not explain the volatility. News has various impact, and one impact is we also look at the scheduled news reduce volatility. We also look at unscheduled news increases the volatility as part of our study. In the literature review, Dr. Bernardo is going to present that to you.
Thank you. So our primary focus for this research was really looking at Hayek's efficient market hypothesis. This goes back to 1945, and obviously a lot of work has been done since then, but this is the seminal article regarding this. What we found is in doing the research or reviewing the research was that the reaction to news really creates sentiment, and that impacts how investors then react to the stock market itself. More recent studies really do focus on investors having greater access to news. As we all know, we have the internet has become more prevalent in this century, and that has allowed for faster, more access to news, which includes more variety of news and the ability to catch it at faster speeds. And some of these studies include Tetlock from 2007, Barber and Odeen 2008, Williams and Stivers as well from 2015. Barber and Odeen's study really did focus on the demonstration of how the volume of news impacted stock sector reaction and investor sentiment. So again, as Dr. Williams stated, the volume does have an impact on news itself. An interesting finding from 2002, Buss and Green, shows that there's a different reaction between retail and institutional investors, and that's generally because they have different investing appetites as well as different access to information. So moving on to the stock and sector performance discussion, some of the research showed that, which was very interesting, is how positive news does yield positive results, but it quickly reverses. However, negative news creates a longer lasting negative result. And that was from Vijay Singh and Malhotra. Another item of interest was the fact that short-term and long-term movement of sentiment, really stocks correlate to short-term sentiment, but generally don't continue to correlate to longer-term sentiment. They tend to revert to their original performance. And then some studies really focused on the differences in sectors, as we did here. But again, we pulled this down to 5 specific sectors for review rather than reviewing all 11. Dr. Williams?
Our research question, we look at 2 research questions. Okay, one was, will stock price have a statistical significant positive negative movement due to positive negative news? Our second research question, uh, uh, we looked at, will stock price fail to have statistical positive negative movement due to positive negative news? In our methodology, Dr. Dames will present that portion to you.
Our methodology included a population proportion selected out of the New York Stock Exchange. And the New York Stock Exchange has approximately 2,800 stocks in 11 sectors and 90 industries. The 5 sectors we looked at were information technology, finance, consumer staples, utilities, and healthcare. From these areas, the type of stocks we looked at were common stock. The percentage of shares by the industry was greater than 15%, with a market capitalization of greater than $1 billion. The betas that we looked at were between 0.8 and 1.2, with dividends greater than 1%.
Michael.
So what we did was we pulled down specific data points to use in the study. These data points specifically included the stock symbol, the company name, the sector and industry, which were from those 5 sectors we discussed, the percentage of institutional ownership, which we looked at greater than 15%, the market capitalization, the 3-year annualized beta, and the dividend yield. In order to select our periods for study, we pulled 4 4-week observation periods from 2018. This included 2 high and 2 low volatility periods that were based on the CBOE Volatility Index. The performance data that we pulled for each stock and sector and market included the actual stock pricing and volume for each day in the period, the sector performance in each period, industry performance, and then the overall New York Stock Exchange market performance and overall volume. Finally, the news stories were pulled to assess investor sentiment, and we pulled those from the Wall Street Journal, MarketWatch, and Reuters.
Our data study shows that the application of population parameters yield 65 stocks. It also showed that the selection of 4 times indicate that 260 possible studies were available. News stories were presented in 97 out of the 260 period. There was 15 instances of statistical significant performance changes represented by 12 individual stocks. Of note, stock and financial and consumer staple yield a statistical significant impact from news. Healthcare, information technology, and utility did not. The research question one asks is whether stock price will have a statistical significant positive negative movement due to positive negative news. A review of the population revealed that 15 of the 97 instances of stock with news stories are presented with a statistical change in performance. Research question 2 asks whether stock price will fail to have statistical significant positive negative movement due to positive negative news. A review of the population proportion revealed that 82 of the 97 instances for stock with news story did not demonstrate a significant change in performance in the presence of news. Dr. Bernardo.
Sure, thank you. So as Dr. Williams said, there were 260 possible study periods, and overall we had 97 of those study periods which contained news. This is roughly 37%. However, there was only significant impact from the news in about 15.5% of those study periods, or really 5.8 or almost 6% of the entire population proportion, which is a result that does affirm the research question 2 that Dr. Williams described. The more notable finding is that while the findings or the results don't affirm research question 1, what's really interesting is there were no significant impacts from news in any stocks and healthcare utilities, and only 1 stock had impact in information and technology, which again, we'll call it a partial affirmation of research question 1 when you consider the study to specific sectors. So in conclusion, the study yielded an implication that stocks in each sector don't necessarily have the same reaction to news. And what this could create is a potential strategy for investing when you're considering reaction to news shortly after the release of that news. So again, 94.2% of stocks with news had virtually no impact on the performance of the stock, while 5.8% of the stocks with news did have a significant impact on performance. And again, what's really key in this is that the impact occurred in stocks that were in the financials and consumer staple sectors.
The need for further research indicate that the study should focus on sectors. One sector that should be considered is studying difference in industry. Another should be extremely homogenized population and broaden the population sectors and industry. And the three major news sources may consider adding blogs. News collected from 1 week should assess this news in subsequent weeks of impact.